Picture this. It's April 1st, 2026. The Income Tax Act of 1961, the law you've known and practiced for your entire career, officially vanishes. So, what exactly happens to your clients' pending tax appeals? What about those ongoing reassessments, or the brought-forward losses sitting on your books? Welcome to this explainer on Chapter 23 of the newly enacted Income Tax Act 2025. If you're a chartered accountant, a tax professional, or a business owner, you're going to want to pay close attention because this chapter is absolutely vital for surviving the transition. It's a massive shift, right? We are talking about a complete statutory overhaul. When the venerable 1961 Act officially ceases to exist, you can't just drop all your historical liabilities and active assessments. You need a bridge between the old world and the new world. And honestly, that is exactly the puzzle that Chapter 23 is designed to solve. So here's our roadmap for today. We'll start with a quick introduction to Chapter 23, then we'll unpack void transfers under Section 499. After that, we'll dive deep into the real meat of the transition, the repeal and savings clause in Section 536. Finally, we'll walk through some practical, real-world scenarios and lock down your key compliance takeaways. Let's get started.
Starting with Part 1, an introduction to Chapter 23.
Now, while this chapter is broadly titled Miscellaneous, don't let that fool you. It governs some incredibly powerful mechanisms, starting with Section 499. The core objective of Section 499 is pure revenue protection. It essentially stops taxpayers from getting clever, strategically selling off or transferring their assets to avoid paying up during or right after a pending tax proceeding. If an assessee tries to alienate their assets just to dodge a tax claim, Section 499 steps in and legally nullifies the whole transfer. It just voids it. Concurrently, we have Section 536. If Section 499 is the shield, Section 536 is the statutory backbone of the entire transition. It does two massive things. First, it formally repeals the 1961 Act effective April 1, 2026. But second, and this is crucial, it ensures we don't plunge into a legal vacuum by preserving specific historical proceedings and rights. Moving on to Part 2, let's take a closer look at Section 499 and those void transfers. When we're talking about safeguarding revenue, timing is literally everything. The law imposes a very strict, specific timeline here. A transfer of an asset is only considered void if it happens during the pendency of a proceeding or after it wraps up, but, and here's the critical cutoff, strictly before the tax recovery officer serves a notice under Section 413. If the transfer happens in that window, the Revenue Department's claim takes absolute precedence. All right, Part 3. Section 536, the Repeal and Savings Clause. Let's explore how this monumental shift safely bridges the two eras of taxation. The biggest sigh of relief for tax professionals is right here. You do not lose your historical tax positions. Section 536 contains 22 highly specific subclauses, essentially acting as a survival kit for the 1961 Act. What does it save? Past assessments and appeals, pending reassessments under the old Sections 147 and 148. It saves your brought-forward losses and unabsorbed depreciation. It even keeps the old beneficial circulars and the faceless assessment schemes legally intact. And you'll see this seamlessly align with the procedural frameworks rolling out in the new Income Tax Rules 2026 and upcoming departmental guidance notes. But here is a massive terminological shift from Section 536.3 that is going to take some getting used to. For decades, we've lived and breathed the terms previous year and assessment year. Well, the 2025 Act simplifies this. They're consolidated into one single concept, the tax year. Going forward, whenever the new Act references a tax year that started before April 1, 2026, legally, it's talking about the corresponding previous year under the old 1961 Act. Now, you might be wondering, what if a bizarre, highly specific situation pops up that isn't perfectly covered by those 22 savings clauses? Don't worry, Section 536.4 brilliantly pulls in Section 6 of the General Clauses Act of 1897. This acts as your ultimate legal safety net, ensuring any rights, liabilities, or obligations you acquired under the old Act are fundamentally protected. It leaves practically zero room for uncertainty.
Let's move to Part 4, Practical Transitional Scenarios. How does this actually play out for your clients?
Let's look at a scenario directly inspired by the CBDT FAQs. Say a business incurs an eligible loss way back in assessment year 2023-2024 under the old law. Fast forward to April 1, 2026. The 1961 Act gets repealed. Does that loss just evaporate? No way!
Thanks to Section 536(2)(m), that validly determined loss keeps its original character. It's seamlessly carried forward and set off under the new 2025 Act rules. The old law governed how it was created. The new law completely respects its existence.
Which brings us to Part 5, Compliance and Key Takeaways. Because understanding the theory is great, but executing it is where the real work happens.
Listen, you have got to update your internal systems and accounting software right now. For example, if you're making a contractor payment after April 1, 2026, and your accounts team quotes the old Section 194C for TDS, you are going to get immediate portal validation errors. You have to use the new Section 393. Same goes for claiming a lower TDS deduction. Throw out the old Form 13, you need to file the new Form 12-8. And remember, all your new statutory forms must use the phrase tax year. If you write assessment year, expect a rejection.
Let's also bust a very common practical myth. A lot of folks might assume that if the tax department issues a reassessment notice in, say, July 2026, for the old assessment year 2024-25, it must be invalid because the old act is dead, right? Absolutely false. Section 536(2)(c) expressly gives the department the power to initiate and continue those historical proceedings under the framework of the old 1961 Act. Here's another trap: trying to revive ineligible loss claims. The Savings Clause preserves valid, legally established losses. It's not a magic wand that fixes past mistakes. If a loss was ineligible or defective under the 1961 Act, it doesn't suddenly become valid under the 2025 Act. The new regime inherits your facts exactly as they legally stood.
So, to wrap this all up, first, Section 499 is the department's shield, voiding asset transfers made to dodge pending recovery. Second, the 1961 Act officially hits its expiration date on April 1, 2026. Third, Section 536 is your safety net, carefully bridging all those old liabilities, valid losses, and assessments into the new era. Fourth, strike assessment year from your vocabulary. It's all about the tax year now. And finally, get your IT systems and TDS codes updated immediately to avoid compliance nightmares. Chapter 23 guarantees that the historical obligations of both the taxpayer and the revenue are protected. The law is clearly ready for this massive transition, but the real question is, are your internal systems and historical records truly prepared, or are you leaving your clients exposed to the ghosts of the past?
Thank you for watching. Please like, subscribe, and share.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.